So it's getting close to tax deadline time. What's the big deal, you know? I always wait till the last minute to do my taxes. Yeah, but this year they changed the law. That looks pretty complicated. So they traded in a few write-offs for something else. It's all just a big game. I can handle it. Might even save some money this time around. After all, they did promise us tax relief. That's relief, spelled M-O-N-E-Y. Money. 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 Money, 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 money. Money!
Good day, Mr. Klein. It's about time you learned how to do your taxes.
Where am I? What is this, a nightmare? Wake up, wake up!
Oh, is that really necessary? Calm down. All right, that's better. You think paying taxes is all a big game. Well, we don't like that attitude.
We? Who the hell are you?
Mr. Klein, there are two things in life you simply cannot avoid.
Yeah, there are a lot of things I can't avoid.
I'm talking about taxes and death.
Death?
Oh, relax. I'm only here to help you because there's a new tax law and it's very different from the old one in a lot of ways. I could have left you floundering, you know. But we at the IRS aren't like that.
Did you say IRS?
That's right.
I'll take death.
Congress may have written the new tax code, but we get to enforce it.
I thought the IRS was a bunch of guys with crew cuts and plastic pencil holders in their shirt pockets.
Yes, well, we've come a long way, baby. Now let's get started. I've got a lot of people to harass today. Rule number 1, plan for and project your tax liability. Do you know where you are right now, Mr. Klein?
What do you mean, do I know where I am? I'm a pawn in a larger-than-life board game. I'm hearing the voice of Ms. IRS and talking to myself. Does that sound like a man together enough to know where he is?
Spare me, Mr. Klein. Now, you can't begin to figure out what your taxes are like for this year if you don't know where you were tax-wise last year. Here.
Hey. Wow. This won't be so bad after all. Listen, it was a pleasure doing business with you. Let's do lunch sometime, huh?
Don't be a wise guy. The IRS hates wise guys. What you have there is your gross income for 1986. Then we'll let you deduct some things to arrive at your adjusted gross income, or AGI for short. Let's assume you have $10,000 in certain expenses that you can deduct. So put that money aside. Adjusted gross income is what you end up with when you take all of your gross income from jobs, partnerships, dividends, etc., and you make adjustments to that income for alimony payments, contributions to an IRA, or other retirement plan. AGI is then used to determine the extent to which certain deductions can be used to arrive at taxable income.
Listen, lady, I knew that.
Oh, really? All right, then. You may advance 1 square. If you can tell me what taxable income is, I'll let you hang on to the rest of that money in your hand.
Well, it's easy. Under the new law, taxable income is adjusted gross income minus personal exemptions and itemized deductions. If I don't itemize, then it's my adjusted gross income less the standard deduction and personal exemptions. So my taxable income should be around $50,000.
Oh, agile mind. Let's hope your body's in the same shape. Looks a little flabby around the middle to me.
Cute, IRS.
Move to your right, please, for tax brackets.
I thought there were only 2 new tax brackets.
Not exactly. Let's start with 1987, shall we? There are 5 transitional rates until the new bill totally kicks in 1988. So put your left foot in 11%, right hand in 15%, that's right. Right foot over in 28%, left hand in 35%. And use your head for a change for the 38.5% top rate. Got that?
I'm getting it.
Comfortable, Mr. Klein? Why don't you get yourself together so we can check out the situation for 1988 tax brackets?
We. I love this we business. At least there are only 2 tax brackets in 1988.
There's an unfortunate misconception about this, Mr. Klein, which I'm about to clarify. The 15% rate will affect singles with income up to $17,850, or married couples filing jointly up to $29,750. Then the 28% rate kicks in, which covers married couples with incomes up to $71,900 and singles with income not exceeding $43,150. But there's also a 33% rate which affects married couples with income of more than $71,900 and singles over $43,150. You should also know that at some point the rate goes back down to 28%. But that's if you're married with a taxable income of well above $170,000 or single with at least a taxable income of $100,000. So you see, there's actually an invisible, I like to call it subtle, third bracket. A 5% surcharge intended to eliminate the benefits of both the lower 15% rate and personal exemptions.
There's nothing subtle about it when you're caught in the middle of it.
When taxpayers talk about their tax bracket, they actually mean their marginal tax rate, or the rate which applies to their next dollar of taxable income.
May I leave this square now?
Oh, just one thing, Mr. Klein. You're married, aren't you?
Yeah? What's it to you?
Oh, believe me, I couldn't care less. I just thought you'd like to know that we've repealed the 2-earner deduction for married couples.
Oh, well, that's just wonderful. Why'd you do a thing like that?
This new bill is supposed to reduce what's been called the marriage penalty. That's the excess tax imposed on joint filers who both work over that of 2 people filing individual returns.
Well, I'm ready when you are.
Very sneaky, Mr. Klein. The IRS frowns on sneakiness. You've got the chance to take a tax deduction or a tax credit. Which one do you choose?
What is this, a quiz show? I'll take the refrigerator.
Time's up, Mr. Klein. What is your answer?
Well, they're not the same thing. A tax deduction lowers taxable income relative to the current tax bracket, but a tax credit reduces taxes dollar for dollar.
Correct. Take a taxpayer in the old 50% bracket, for example. $1 in deductions would generate 50 cents in tax savings, but a $1 credit would equal $1 in savings. So what's it gonna be?
The tax credit.
Wrong, Mr. Klein. The new tax code has phased out many tax credits, like those for energy conservation and political contributions. To maximize tax savings, you should have picked tax deductions. Do you have that straight now? But you did know the difference between a deduction and a credit, so you may advance 1 square.
Thank you. All right. Tax-free space. What does that mean?
Do I have to explain everything?
I have to explain anything.
Under the new tax code, certain types of interest income will still be tax exempt. For example, you'll still be able to earn tax-free interest for most municipal bonds.
Oh, well, that's comforting.
Well, we can't have you getting too complacent. You better move up 1 space and pick a card.
No doubt they're stacked in my favor. Phase out.
There is now a phase-out of the 60% exclusion on long-term capital gains.
Sounds like a lot of mumbo-jumbo to me.
Mr. Klein, the IRS does not talk mumbo-jumbo. Why don't you pay attention and try and learn something?
Oh, boy, just like school.
That's right, Mr. Klein. And do you know what the IRS does in place of detention?
No, why don't you tell me, teach?
We audit.
Okay, I'm ready whenever you are.
I knew you'd see it my way. Certain items from the old tax code are being phased out or eliminated. For example, you will no longer be able to exclude 60% of long-term capital gains from being taxed. That's when the assets were held for longer than 6 months. From now on, capital gains you've gotten from stocks or other assets like collectibles and gold are going to be taxed at the same rate as regular income. Beginning with your 1987 tax return, gains will be taxed at a top rate of 28%, and then up to 33% after 1987. If you sell your home, the gains will be taxed like ordinary income, but the IRS has not changed the following provision from the old law. The profit on the sale of your home will not be taxed at the time of the sale as long as you buy a new home for at least the same amount of money within a 24-month period, either before or after you have sold your home. Also, people over 55 will still be allowed a one-time only opportunity to exclude from taxation up to $125,000 in profits from the sale of a primary residence. Did you get all that?
Yeah, right.
Good, because we're moving on.
By the way, are we having a good time?
Certainly we are, can't you tell? Please take a card. It's time to look at how you could plan for your tax payments.
Ugh. I never thought playing cards was such good exercise.
Oh, let's save the clever lines for me, shall we? Besides, you just had a phase-out card, but this one is quite different. This is a phase-in. Certain equations in the new code are being phased in or added in stages. One example is your personal exemption. For 1987, it'll be $1,900, jumping to $1,950 in 1988 and up to $2,000 in 1989.
Oh, this is just too much fun for words.
I want you to pay careful attention now to the floor, Mr. Klein. The new code has a big thing for floors.
Are we talking parquet or wall-to-wall?
Oh, that's cute, Mr. Klein. The IRS detests cuteness. We're talking IRS floors. Very simply, that means the amounts of money in excess of adjusted gross income you now need to qualify for certain types of deductions. Some of the floors have been increased over previous years, but some of them are brand new.
Oh, I get it. What the government giveth, it also getteth.
What, are you a comedian? I forgot to laugh. Please climb up to the new deductions floor. Here, you have your miscellaneous itemized deductions, your business expenses, your medical and casualty deductions. Now, if you move over to where it says 7.5%, it'll now take 7.5% in medical and dental expenses exceeding your AGI to qualify for a deduction.
That's one hell of a deal. Didn't it used to be 5%?
Hey, on this bill, you win some, you lose some. Here's a tip for you. It would have been helpful if you had given some thought to organizing your 1986 taxes before January 1st. But of course you didn't. You could have taken advantage of the 5% medical floor from the old law. That is, if you had already paid for things like eyeglasses, your annual physical, drugs, gotten root canal work done. Why, you could have even gotten that plastic surgery you want and need.
Cute. Since I can't see you, I'll just ignore that. So what's the story with casualty deductions?
That still has a 10% floor.
Well, you just know it all, don't you, lady?
Yes, I do. Why don't you just make yourself comfortable and move down to that 2% floor for employee business expenses? Most types of unreimbursed employee business expenses for things like travel and transportation are now lumped together with miscellaneous itemized deductions like union dues, subscriptions, tax preparation fees, and so on. There's a 2% floor in this category now. That's 2% in excess of your adjusted gross income.
And what about business meals and entertainment expenses?
Tough luck. You can only write off 80% now.
I need a minute to catch my breath. This is more...
We interrupt this program to bring you this bulletin. You can minimize your tax bite by adjusting your withholding tax throughout the year. Why give the government what amounts to a tax-free loan by letting Uncle Sam take excess taxes out of your paycheck? Change your withholding during the year according to how much money you're making and what your tax projections are. Just fill out the W-4 IRS form you get from your employer. But whether you withhold or file estimated tax, be advised, that the new law requires you to pay 90% of what you owe from the current year. That's up 10% over the old law. Or you can still pay 100% of what you owed from last year to avoid a penalty. We now resume our regularly scheduled programming.
Consider, if you will, a space where reality and fantasy merge. It's called the tech zone.
Do you believe in timing, Mr. Klein?
Well, it all depends on what...
Actually, we don't care. Step over to the dice table. I'm going to
Dice
show
table?
you how timing your income
Over
and
here?
deductions can be used to actually decrease taxable income. It's like a series of stop-and-go
Hey.
tactics. Roll 'em, baby.
Okay.
You can decrease your taxable income by deferring your income and/or accelerating your deductions. You can increase your taxable income by doing the reverse, accelerating your income and/or deferring deductions. Okay, Mr. Klein, it's time to take out your money.
Sure, it's easy for you to say.
Well, it's fairly safe to assume that most people want to decrease their taxable income if their tax bracket will be lower the next year.
Unless they're masochists, yes.
Okay, let's take your taxable income of $50,000. Put it on the table. And now, let's suppose there's a $5,000 tax-deductible expense that you knew last year you were going to have early this year.
Okay, I think I know what you're saying.
Oh, no, you don't.
Oh, yes, I do. I could have made the payment last year and taken the deduction on my 1986 return. Well, let's assume I made it in '86, and I'm going to take it anyway.
Oh, nice try, Mr. Klein, but no cigar. It's too late now. And just to rub it in, I'm going to show you in dollars and cents just how much money you could have saved this way. Take someone, for example, with $1,000 in expenses in 1986 in the 50% bracket. That amounts to $500 in savings. But in 1987, at the top rate of 38.5%, that same $1,000 in expenses only saves $385. Do you understand?
Oh, sure, now you tell me. Why didn't I know this before last January so I could have made some provisions to make an early payment and get the deduction?
Just who do you think you're kidding? Remember, Mr. Klein, we are the IRS. We know when you've been sleeping, we know when you're awake, we know when you've been bad or good, and we know how disorganized you are. Actually, there are a number of things you could have done to save money if you had been a little more together about paying your taxes. Now pay close attention, because some of these strategies will still work for 1987 or later. And tell him what he could do, Mr. Announcer, while I sharpen my pencil.
First, let's look at what you could have done to help out with your 1986 taxes. For example, as you already heard, you could have made an early payment on medical expenses you had already incurred to get you over the 1986 5% floor on medical deductions. If you had some spare cash handy, you could have bought some big-ticket items to take advantage of the sales tax write-off because it's eliminated as a deduction after 1986. You should still think about paying off as much consumer debt now as you possibly can. It's being phased out as a deduction through 1990, so you're better off getting rid of the debt. And charitable contributions are only deductible as of 1987 if you itemize your deductions. Oh, and one more thing you can still do. If you think you're going to owe additional state taxes, you could pay them early and take the extra write-off. They remain tax-deductible under the new plan.
One more move like that and it's a 3-year audit.
Ooh, hey, that's harassment, lady.
Maybe, but it's certainly effective. Now, a lot of people have already spent a lot of time trying to figure out how to defer their income until 1987 or 1988, when the lower tax rates kick in. You can also defer that bonus you've been promised. You can defer part or all of your salary, or if you own your own business, you can time your income receipts to delay what might normally be year-end billing into the beginning of the next year.
Now, this is more like it. Deferral.
You are guilty of constructive receipt.
Whatever it is, I didn't do it.
Just a little warning, Mr. Klein. You can defer the taxation of income only if you meet a fairly rigid test. Constructive receipt is IRS ease for saying you can't defer income if the money has been received or if it's being used either directly or indirectly to benefit you. That means the money can't be set aside or made available for you in a separate account in your name. You're also not allowed to refuse the compensation if it's yours for the taking. Then you get slapped with the tax applicable at the time you deferred the income.
That's what I like about these laws. Simple, straightforward language. Nothing confusing about this at all.
Oh, I know. It's tricky. That's why God created accountants.
Very cute.
Now, all that aside, it's your move. You can take the rest of your money. Oh, trust me, we'll tax you on your constructively received income. Or you can try and save more if you see any more deductions.
Well, what about charitable contributions? After all this, I'm obviously not using the short form, so I can write off charitable gifts. Here, I had a good year in the stock market. My $10 stock went up to $100 a share, so I'm in for $1,000.
Oh, careful, Mr. Klein. Before the law changed, you could still take a $1,000 charitable write-off. But now, it's become a new preference item. So you could end up paying an additional tax on your stock profits. This other tax, the alternative minimum tax, or AMT for short, always existed, but now it can also affect areas like charitable contributions as well. So move it to the AMT area, Mr. Klein.
But I've never understood this alternative minimum tax.
Yeah, well, I hate to tell you, Mr. Klein.
Oh, I'm sure it's killing you.
The AMT has been beefed up from 20 to 21%, and the number of preferences have been increased. Figure that it's your AGI plus certain tax preference items and other adjustments, minus certain permitted itemized deductions, and minus an exemption amount.
So what's the big deal?
Ha, not so easy, eh, Mr. Klein? We always allowed a $40,000 additional deduction for AMT if you were married, but now it begins to get phased out once you exceed $150,000 in alternative minimum taxable income. Okay, try again, Mr. Klein, if you're brave enough.
Sure, I've always wanted to play potsy at my age.
As you can see, Mr. Klein, taxpayers who manage to escape the 28% bracket by using lots of deductions and credits can only escape so far. Quiet, please. This gets a little tricky. But the 21% AMT rate will even affect the earnings on some newly issued tax-exempt municipal bonds for non-public projects. So municipal bonds for government projects like roads, schools, airports, etc. will remain tax-free, but new private sector municipal bonds may be subject to the AMT. I know it's hard to believe, but the AMT was set up to prevent wealthier taxpayers from using credits and deductions to escape paying taxes.
Great, wonderful. You people do an incredible job. Just get me out of here.
All right, Mr. Klein. Now turn left. Now right. Now, no, wait, left. No, don't step on that line, you idiot. Turn left. Okay. Oh, no. Come forward. Turn left. Now right. Now, oh, you're on the line again.
This is not fun.
Hey, you want fun? Go to Disneyland.
Is it tax deductible?
Oh, cute, Mr. Klein.
Just a little humor, IRS. Forgive me.
Just move up one more space.
All right, I'm here. Now what happens? All right. This is more like it. I'll go for the fur coat, the 14-karat gold ankle bracelet, and the home entertainment system.
Oh, and I'm just so happy for you, Mr. Klein. How are you planning on paying for all of that? Haven't you heard? We're phasing out the deduction for finance charges from things like credit cards and car loans.
I have to pay for it? I thought it was part of the game.
Mr. Klein, this is not Wheel of Fortune, and believe me, I am not Vanna White.
Who's Vanna White?
Oh, never mind.
I'll have to pay for it, huh? Well, since I won't be able to deduct the interest from charging it on my credit card, I'll borrow against appreciated value of my home.
Clever, Mr. Klein, but not quite clever enough. Listen carefully. I'm not going to repeat this. Home mortgage interest is still fully deductible up to the fair market value on first and second homes if the loans were made by August 16, 1986. After that, I'm afraid you can only deduct the interest on mortgages equaling the original price for your home plus any improvements. But there is one exception. Interest on loans secured by your home that are used for medical costs and/or education are deductible up to the market value of your home.
That means I have to keep very careful records. Isn't there some kind of law against generating unnecessary paperwork?
We are the law, Mr. Klein.
Oh, sorry. How's about some tips on tax loopholes? You must have left some of them in the new bill.
But the whole purpose of this bill, Mr. Klein, is to close up those loopholes. Besides, we at the IRS don't like that term. But there is a tax-saving strategy. Move up on the board.
Tax shelter. Oh, isn't that like railroad boxcars or something else highly speculative the super wealthy invest in to get a write-off?
Oh, Mr. Klein, you certainly don't think we would encourage such risky business, do you now? No. In fact, you'll be happy to know most tax shelter losses taken against earned and investment income will be phased out over the next 5 years. If you ever have taxable income from those investments, we'll let you deduct the losses we disallowed in the earlier years. But there is something you may be interested in. Some call it the poor man's tax shelter.
Hey, now you're talking. I'm all ears.
Yeah, I noticed they were rather large.
Thank you.
All right, pay attention. If you're active in the management of a rental real estate property, you can claim up to $25,000 in losses to offset other income. So if you have up to $100,000 in AGI, that would mean you'd probably be in the 33% tax bracket. That means you can take the full $25,000 against your other income. But that's only up to $100,000 of AGI. After that, the allowance is phased out until you hit $150,000 when no current deduction is allowed for rental real estate property. Now move over to that area marked income shifting.
You know, I could use a little help here. I've got a kid, and saving some money for his college education would be a big help.
Oh, now, Mr. Klein, don't you think I know that? A major goal of tax planning is to protect and increase the wealth of the family. You could do that by a series of maneuvers called income shifting. Now, shift to your left. Now, you've just shifted income from your high bracket to your child's lower one. It's still possible under the new law, just a little trickier.
Trickier? I thought the whole purpose of this new law was to simplify things. Now make up your mind. I'm confused.
Yes, I know you are. What this new law does is prevent people from taking large sums of taxable income and shifting it over to their kids' lower brackets.
Doesn't that make it tougher to save for the kids?
It's not impossible if you know what you're doing. Here's how it can be done. If a child is under 14, then any unearned income like interest and dividend income of more than $1,000 gets taxed at the parent's bracket. The first $500 is tax-free, and then the next $500 of the child's income gets taxed at the child's bracket. After that, the child pays the tax figured at the parent's rate. But once children reach 14, they pay tax at their own rate. All right, Mr. Klein, take a step forward. Now turn around. Now take 2 steps forward. Now back. Now do 2 jumping jacks.
What is this, a Jane Fonda workout?
Just a little humor, Mr. Klein. We at the IRS are into fiscal fitness.
Watch my lips. I'm not laughing.
Yeah, well, if you're still listening, I'll show you some ways to save by income shifting.
If you don't kill me first.
Don't tempt me, Mr. Klein. Have your children earn at least $1,000 in their own names, because they'll pay only $75 in tax after that. And look for investments where you can defer taxes until your child reaches 14. Because after age 14, any savings liquidated are taxed at the child's and not the parent's bracket. All right, Mr. Klein, now hold out your hand.
What's this?
Why don't you figure it out? It's your move.
Well, I know. I'll sock some money away here in Series EE savings bonds. They'll mature after my kid turns 14, and the interest doesn't get taxed until we cash in the bond.
Okay, it's still your move.
How about here, a life insurance policy?
Well, that's good, but make sure it's the kind with cash value buildup that's not subject to taxation, like a whole life or universal life policy from a quality company.
Oh, so I can defer tax again until my child cashes in the policy after he's 14. And I'll sock some spare change right here in municipal bonds. Well, because the interest will be tax-free.
I'm sure you didn't know the same income shifting strategy also works if you're supporting an elderly parent. You can shift money over to the parent's lower bracket, but it only works if they are in a much lower bracket than you are and if you are supporting them.
Hey, what about those fancy schmancy trusts that Rockefeller types use to shelter their money from the government? Why don't you tell me about those, huh? And I could be a multi-millionaire.
Spare me. If you're talking about Clifford trusts or short-term trusts, where property is transferred for more than 10 years, we come down pretty hard on these under the new law. The same thing with spousal remainder trusts, where income interest goes to a lower bracket family member. Any of these trusts set up after March 1st, 1986, will not shift income to the beneficiary.
I'm going to be an old man by the time you take me through all these changes.
Oh, and whose fault is that?
Now, just a minute. I didn't change the law.
Look, just hightail it over to pensions and profit sharing, please.
No, I don't feel like it. Got those IRS blues, because I don't understand the new
that's
tax
great.
law.
Mr. Klein, that's great. Do you know Melancholy Baby?
Well, as a matter of fact, I do. All right, okay.
Mr. Klein, I only have one nerve left, and you're getting on it very rapidly. Now, if you're through with the theatrics, I'd like to remind you that it's still possible to sock money away into your IRA, even though some of the rules have changed. Mr. Announcer, why don't you take it away?
Well, Robert, any wage earner not an active participant in a company-sponsored retirement plan can still deduct up to $2,000 a year for IRA contributions. A worker who's covered by such plans but has less than $25,000 of adjusted gross income and is single, or $40,000 of AGI and is married, can still take the full $2,000 deduction. But if you're single and your AGI is over $35,000 a year, or married with $50,000 or more in AGI, and you have additional pension coverage, you lose all IRA deductions. Singles with AGI between $25,000 and $35,000 and couples with an AGI between $40,000 and $50,000 will face phase-out of their IRA deductions if they're covered by a retirement plan at work.
Something tells me I'm going to move again.
I call the shots here. Pick a card. Any card.
Again with these 500-pound cards? Another phase out.
That's right. For every $1,000 over the IRA cap, your IRA deduction is reduced by $200. Here's the partial deductions breakdown. For each $1,000 of income over the IRA ceiling, you end up losing $200 from the amount you can deduct from your income for your IRA contribution. And of course, when you get to this level, $35,000 or more for singles and $50,000 plus for couples, the IRA deduction is totally wiped out.
But I can still put money into an IRA if I want to, can't I?
Certainly. It doesn't matter how much money you make. You can still put in up to $2,000 in an IRA, and the earnings will remain tax-deferred until withdrawal. You just can't deduct your IRA contribution from your income.
Listen, Miss Know-It-All. Isn't there some alternative to the IRA?
Yes. The 401k.
What?
The 401k!
Sure, the 401k.
The 401k is a form of salary reduction plan because you can defer paying taxes on the money you've invested in the plans.
Great. So how do I sign up?
Oh my, aren't we impatient? We've just lowered the ceiling on contributions from $30,000 a year to $7,000. And most importantly, you make your contributions through payroll deductions. The employer decides whether to set up the 401k. If you withdraw your money early, that is before the age of 59 and a half, you may pay a 10% penalty tax. But there are some extenuating circumstances, such as death and disability.
Oh, I'd say death is an extenuating circumstance.
You also don't have the right to withdraw your money before you retire.
What about a pension plan for someone who's self-employed like I am?
That's called the KEO. Pay attention, it's right there in front of you.
Who makes up these dumb names?
I do, Buster. Want to make something of it?
No, I'm just asking. Oh, that's nice, nice.
You can get some of the benefits of tax deferral by putting money into a KEO plan. You can invest up to 20% of your net earnings from self-employment if you use a profit-sharing type of KEO plan. But it could go even higher if you use a KEO that's structured like a pension plan.
So what's next, Chief?
Oh, why don't you just move to vesting?
Vesting, okay. Go vest, young man. I hope this is good news. I don't think I can take any more complications.
Here, catch. We changed the laws on vesting. That means you now have the right to pension benefits after only 5 or 7 full years of service.
Oh, yeah? It used to be either 10 or 15 years, right?
Right. You either have to get 100% vesting over 5 years or 20% after 3 years of service, with the balance spread out until 100% vesting occurs after 7 years. Now move into the next area.
Why do I think you're giving me the good news before you give me the bad news?
Oh, suspicious mind, Mr. Klein. Would I do that to you? I was only going to tell you that there have been some changes made affecting lump sum distributions from qualified retirement plans.
Lump sum distribution. That sounds like a Chinese restaurant.
I'll ignore that one, Mr. Klein.
For once, I don't blame you, IRS.
You used to be able to take 10-year averaging if you got a lump sum distribution of money from a pension or profit-sharing plan. In other words, this was a favorable method of paying tax on that lump sum of money that was calculated as if you received it over a 10-year period. Now, that's been eliminated and replaced by 5-year averaging. But if you were born in or before 1935, you can still 10-year average under the 1986 rates or 5-year average under the rates in effect when you get the distribution. You also still have the option of rolling over the entire amount into an IRA if you want.
Well done, IRS. I actually followed that one.
Oh, flattery gets you nowhere with the IRS, Mr. Klein. Move up one block.
All right, it says tax-free. What do I get?
You don't get anything, but you can keep fringe benefits tax-free, like company-paid health insurance and group life and legal insurance.
Well, I'll make a note of that one.
Oh, you better have lots of notes, Mr. Klein. It's time for you to go to the last space. I mean, I do have a federal deficit to worry about.
Okay. Look, you're gonna let me out of here?
Believe me, I'd like nothing more. But first, see if you can answer this last simple question. Will you be able to deduct the cost of your education?
I don't see why not.
Then your answer is yes.
No.
Then your answer is no.
Well, yes. I mean, no. I don't know. It really all depends.
Depends on what?
You're the know-it-all. You tell me.
First, let's start with costs for degree-bound students. Scholarships or grants that cover direct education costs, like tuition, books, and fees, remain free from taxation. But funds that are not for direct education costs, like room and board, will be taxable. And students who are not getting a degree are now taxed on all scholarships and grants. All education loans are considered personal loans, and the same phase-out for consumer debt applies through 1990. But don't forget about this possibility. You can use a home-secured loan to pay for your education expenses. There's even a special provision which allows you to deduct interest on educational loans up to the market value of your home, minus any other mortgages.
So in other words, it does all depend.
Mm-hmm.
Then say it.
You were right.
I can't hear you.
You were right.
I was right. I was right. I was right. I was right. I was right. I was right. I was right. Oh, what a nightmare. Ugh, must have been this double pepperoni pizza.
Nightmares have a way of becoming real, Mr. Klein.
Oh, wait a minute. This cannot be. How did you get in here?
We're the IRS, Mr. Klein. We're everywhere.
But you can't just barge into people's homes.
Why not? We repossess them. Now, are you going to do your taxes or not?
No, I'm doing them, man. I'll do them.
Good. Then I'll be back next year to explain things all over again.
Oh, no, you won't.
Oh, yeah, and what makes you so sure of that?
Because next year, I'm buying the videotape.